Hello and welcome to this contenders session where I'm going to be going over in this video swing trading. Okay, so as always, reminding you of the important legal trade disclaimer. Please pause, read through this, take your time, and once you have understood and agreed with all, let's continue and start today's session of swing trading. Okay, going over the ins and outs of this, starting with the utility, moving on to the implementation, and ending, of course, with the tips and tricks. So the utility of swing trading. Swing trading is great for those with less free time. Essentially, many of the people in the group, that have a full-time job, that have a family, that just have less time to dedicate to trading. Swing trading is the preferred method, generally speaking, for these people because it requires less of your time looking at the charts and trading. Okay, and one of the biggest benefits, I would say there are many benefits of swing trading. But one of the biggest would be in comparison to scalp and day trading would be that with swing trading, it is a much more relaxed way of trading. And what would that be? Why? Well, you will take way less trades as a swing trader, but those trades that you do take can be very well planned ahead of time. I would say, as a direct comparison between a scalp trader that's taking, let's say, 10 trades an hour versus a swing trader that's just taking only one trade a week on one asset, it is very much likely that that scalp trader taking more trades will actually take home more money in that direct comparison between one trade a week versus 100 trades a week. I'd say the scalp trader will make more money overall. So that's also something to bear in mind, but that's not to say you cannot make great profits from just swing trading, which is a style I'm getting more into. But the implementation of this. So I personally love the 4-hour time frame for swing trading when viewing the chart. Monthly and weekly viewpoints are also key. So I'd always start on these higher term time frames, but then start to bring my way down. And I love the 4-hour time frame view once I've done my higher term time frame analysis first. I'll generally be sticking on that 4-hour chart. Okay. I most often take the trade from a 30-minute viewpoint. So that means I'll do my analysis on the higher term time frames, generally keep my chart on the 4-hour, but the 30-minute is where I will execute that trade. And that is what I obviously explained in this video. So I love to trade with horizontals, NPOCs, and liquidity points. The best trade entry for triggers for me would be a swing failure pattern of a higher term time frame level or a failed auction of a range. Trade entry would be max from 4-hour swing failure pattern time frame view, but I most often trade from 30-minute chart swing failure patterns. Okay, what I mean by this is, for example, on a 1-minute chart, that would look like a failed auction coming up, spending 3 minutes above a high, coming back down. On a 1-minute chart, you wouldn't say that's a swing failure pattern. Okay, but from a 4-hour chart, that would just look like a wick up and back down, and a swing failure pattern, not a failed auction. So I will accept 4-hour swing failure patterns, but more often than not, I am very much trading from 30-minute charts for this. That's where I'm taking my entries. And so a 30-minute chart showing a swing failure pattern wick is absolutely acceptable for me as a trade entry for an SFP. Even if on the 5-minute chart it wasn't a swing failure pattern per se, it's more of a failed auction. And that, of course, these things I'm talking about here, swing failure patterns, understanding time frames, failed auctions, that's all taught within previous lessons. Okay, so set alert above or below liquidity level for a swing failure pattern. So this is how I'm starting to look to take my trades. Okay, I'm going to recognize a higher term time frame level of confluence, and I'm generally then waiting for that level to be hit and then seeing a swing failure pattern form off of that first touch. Okay, let's see, touch a level, get a bounce. I'd wait for an SFP of that level to be hit, or a big level of liquidity that I've identified. I'll wait for an SFP of that high level liquidity. So I would set my alert on that high level of liquidity as a swing trader and wait for price to hit that level. Okay, so set alert back inside of the range for a failed auction. So if I'm waiting for a failed auction and prices come above a range, I'd set my alert back inside the range. So if that alert goes off, I know there's been a failed auction. Once the alert goes off for either an SFP or a failed auction, I will of course then be waiting to see if there is actually a visible reaction. And if there is a swing failure pattern forms or a failed auction holding on the 30-minute chart, well then simply I will take that trade. I will sometimes wait for 2 consecutive 30-minute candle closes before I enter a trade. This is if I'm more conservative. So let's say we see an SFP wick. I will then wait for 2 consecutive 30-minute candle closes below that, okay, to enter the trade. The same for a failed auction. Just, removes kind of a thing where you'd see a swing failure pattern back below, and then, the next candle is continuation to the upside. I generally do not wait for this often, but this is a more conservative way. For me, if I see that swing failure pattern close on the 30-minute with the wick above, I would take the trade. I'm more aggressive though with my entries. Once entered, the stop loss placement is always above. If the swing failure pattern is above the range high, or the failed auction is above the range high, the short is entered, stop loss above the top of that wick, target can be low of the range, okay? Or of course, the highest/lowest point of the failed auction. So again, let's say then you got a failed auction of range low, back in the range, enter long, stop loss below the lowest point of the failed auction. My first target will generally be an intraday level such as the VWAP or a swing failure pattern 2.0 target, which goes off of our higher low market structure. Occasionally, the value area high of the range can be used as the take profit 1-2, as this is a reversal zone if no acceptance is found. Take profit 2 can be a trading stop loss now in profit, or the range value area low / major level of liquidity, which is generally, the range overall range low wick or range high wick, okay, the opposite side of where you've taken the trade. But you can of course just trail that stop loss if you don't want to lock in a take profit 2. Okay, so this is a visual way of understanding exactly what I'm looking for. So let's say I'm a swing trader. This is what I'm viewing on the chart. Well, I'm not going to enter my short trade now, am I? Because we've not taken a high level of liquidity. There's no confluence here or reason for me to enter a long trade. I've not hit my entry trigger, which would be waiting for an SFP or failed auction. So what will I do? I will recognize the liquidity above this high for a potential swing failure pattern. So I will set my alert above this level. With the alert set, then I would have to remain patient. One or two things would happen next. I would either have my alert go off, 30-minute close above and back down for an SFP, or alternatively, price comes up, hits my alert, and just continues upwards. And if that's the case, I do not take any trade at all and would just continue to wait then for a potential failed auction. Or of course, I'd put my alert back into the range, or price just carries on upwards and I look for a brand new setup to occur. Okay, here we actually see an alert goes off. Okay, so this would be on the 4-hour chart from this example, but simply price comes above the level, back down. So you've had your alert go off, you've had a reason now to enter a trade. So you check to see after the alert goes off, has there been a swing failure pattern? If there has, then now is the time to enter the short entry. Stop loss is above the wick. Target could be a few different places. We could pull a fixed range of this and look for the value area high. Alternatively, we could go for the overall low of the range, where that's the next biggest liquidity point below price. So understand first take profit target, which again, we could use the value area high of the range because price could potentially test that and then continuation to the upside. So it's always a nice take profit one. Alternatively, you could use an intraday VWAP is another acceptable take profit one for me quite a lot of the time. Then take profit 2, I can look for the value area low or the overall low of the range. Or the value area low is acceptable. Or alternatively, if price come down here and started making its way lower, hit take profit 1, and then a stop loss I could trail. So I could trail that stop loss down with price, not having to lock in anything in case we get a much bigger drop to the downside. So we can see what happens here in the end. This is the outcome. Price come down, hit the value area high, which could be, definitely acceptable take profit 1. From that, you do get a bit of a bounce. And then continuation down to the value area low. And look at this, value area low, got a bit of a bounce before making its way down to the overall low of the range for another bounce to the upside before coming down for further continuation. Okay, so price hits take profit 1 here off of the value area high, small bounce down to the value area low. At this point, we would look to move stop loss to entry or for lower. Okay, so what I will generally do is once we've hit take profit 1, stop loss can be moved to entry or kept above price. Depends on, I would say there's a few factors that come into this because it is always different for me. When I hit my take profit one, there are times where I'll move stop loss to entry, and sometimes when I hit take profit one, I will keep my stop loss at its original invalidation. Because if we're trading for a swing failure pattern with a target much lower, price coming down to hit take profit one does not mean the invalidation of the trade has changed. That's to protect profits, but the invalidation from a swing failure pattern entry is still above that high, right? And you will see many times if you move your stop loss down into profits, then you will see yourself stopped out and then continuation because the invalidation remains above that high. So this is something that you have to take into consideration of how far away that take profit one is, and whether if price comes to your to your entry, does that invalidate your trade idea? If price our take profit one was the value area low, let's say, or then if price come back up, let's just take this as an example. Our entry is here, our take profit one is the value area low here. Or if price come down to hit take profit one, it would be absolutely acceptable to move stop loss to entry, because if we get back above that value area high, then it's much more likely we're going to come back up to form a new high. So I would move my stop loss to entry. But in this example, if I've entered here, hit take profit one, my invalidation is still above the high. So moving stop loss to entry would be not the correct thing to do. So again, the take profit one is always a must. You should always take profit one. But whether you move stop loss to entry or keep it at invalidation is based on context, basically on the trade. There are times when it is recommended. There will be times when it's recommended to not adjust the stop loss. So ending with some tips and tricks. Don't get too greedy on the first take profit, but also don't, take too much of a higher percentage. I like to take on average around 15%. There are times where I would take it as little as 5 to 10%. There are times where I might take 75%, but that's very unusual. Okay, generally averages around 15 to 25% on a first take profit one. After the first take profit is hit, you can move stop loss to entry or into profits, but I generally do not move it from its original place until take profit 2 is hit. If you miss an alert trade, do not worry. There is always another trade to come. The worst thing that we see is planning out a swing trade. You see in the group sometimes, 90% of people get in the trade. We've planned for it. It comes to the entry. We take the trade. There's some, you might be at work. You might have whatever reason why you missed the entry. And then prices already rose 5% and you enter in 5% too late. And now you've got a massive invalidation. If that trade doesn't work out, you're taking a big loss. It's just, don't get into that scenario. If you miss the trade from the original entry, do not worry. There's always another trade to come. And yes, I understand if you're waiting a whole week for a trade and that is your one trade of the week and you miss it, you might be slightly annoyed, but you have to remember, well, next week there's another trade. Let's not get annoyed. Let's not worry. Let's write down why we missed that trade, what happened, and just make sure you're ready next time it comes. Maybe make sure you have an alert set if you're planning to do something and you are able to get to a computer or check your phone. Have an alert set that will alert you. So if you're doing the laundry, you have your alert set so you're ready to take that trade and not miss it, for example. Okay, so thank you for watching. Hopefully you've enjoyed this swing trading session. It's relatively simple. I think once you've locked down the skills necessary from the other modules, swing trading is a nice way to go about it. So as always, a live stream covering the question and answers about this session will be hosted on Wednesday. You can submit your questions for this live stream via the Discord in the Q&A channel as always. And of course, Trading Assistant will be there to help you 24/7. So hope you've enjoyed. Thank you ever so much. And I'll catch you in the next one. Cheers.